The information provided in this video is for general informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.
Welcome back to Iron Financial. Today we are tearing down the e-commerce and cloud titan, Amazon. It is January 2026, and the company is at a massive inflection point. We're looking at a stock that has retested all-time highs, but is currently battling a narrative war between massive AI spending and retail efficiency. Let's dive straight into the recent news. The headline story for Amazon entering 2026 is the aggressive rebranding and rollout of its Space Internet initiative. In November 2025, Amazon officially renamed Project Kuiper to Amazon Leo. This isn't just a marketing gloss. It signals the shift from experimental project to consumer service. With services launching widely this year, Amazon is finally taking a direct shot at SpaceX's Starlink. The news cycle has been dominated by this launch, as it represents Amazon's attempt to own the infrastructure of the internet, not just the storefronts upon it. On the earnings front, the narrative is acceleration. After a sluggish 2024, AWS revenue growth re-accelerated to over 20% in late 2025, a critical signal that the cloud optimization cycle is over and the AI deployment cycle has begun. However, this comes with a heavy price tag. Amazon confirmed a staggering $125 billion in capital expenditure (CapEx) for 2025, with plans to increase that in 2026. This has spooked some investors who fear a repeat of the profitless growth eras of the past. Comparatively, the news cycle for competitors is equally aggressive but focused differently. Microsoft MSFT is currently winning the mindshare war with its OpenAI partnership, but Amazon's recent landmark deal to provide infrastructure for OpenAI has successfully hedged that bet, proving AWS can't be ignored even by its rivals' partners. Meanwhile, Walmart WMT has been generating headlines for its e-commerce profitability, growing online sales at 27%, nearly triple Amazon's retail growth rate, signaling that Amazon's retail dominance is under its most serious threat in a decade. Moving into the numbers, we need to look at NVIDIA's financial health not just in isolation, but in direct contrast to its peers. As of early 2026, NVIDIA is trading at a price-to-earnings (P/E) ratio of approximately 46.4x. On the surface, this sounds expensive compared to the broader S&P 500. However, when you compare it to AMD, which is trading at a trailing P/E of over 100x due to lower recent earnings, and a forward P/E closer to 50x, NVIDIA appears more reasonably priced relative to its realized profits. Intel, conversely, trades at a distorted multiple due to depressed earnings, often showing a forward P/E in the low 20s, reflecting the market's skepticism about their growth. A critical metric here is the PEG ratio, price/earnings to growth, which contextualizes the premium you pay. NVIDIA boasts a PEG of roughly 0.72. In the world of investing, a PEG under 1.0 is considered cheap for a growth stock. This suggests that despite the high stock price, the market may still be underestimating the speed of NVIDIA's earnings growth. Compare this to AMD, which sits at a PEG of around 1.3, indicating investors are paying a steeper premium for AMD's future growth than for NVIDIA's. NVIDIA's price-to-book (PAB) ratio is an eye-watering 38x, vastly higher than Intel's 1.7x or AMD's 5.8x. This reflects that NVIDIA is a capital-light designer. Its value is in intellectual property, not factories. Efficiency is where NVIDIA truly shines. Their return on equity, ROE, is nearly 30%, significantly outperforming AMD, which hovers in the single digits, around 4 to 7%, and Intel, which has struggled to stay positive. Finally, the debt-to-equity, D/E, ratio for NVIDIA is a pristine 0.09. This is a fortress balance sheet. In comparison, Intel has a D/E of roughly 0.44, burdened by the heavy capital costs of building foundries. NVIDIA has the financial flexibility to weather storms that would cripple its rivals. Let's look at the hard numbers. As of early 2026, Amazon is trading at a price-to-earnings (PE) ratio of approximately 32x. Historically, this is quite reasonable for Amazon, which has often traded north of 60x or 80x. However, context is everything. Microsoft trades at a similar premium, around 30-33x, but Alphabet, GOGL, remains the value play of big tech, trading significantly lower at roughly 20-22x earnings. This suggests the market is pricing Amazon with a moat premium similar to Microsoft's, largely due to the AWS profit engine. Looking at efficiency, Amazon's return on equity, ROE, has climbed back to a healthy 24%, a testament to Andy Jassy's ruthless cost-cutting in the fulfillment network over the last 2 years. Compare this to Walmart, which typically operates with a lower ROE due to its heavy brick-and-mortar asset base. However, Amazon's debt-to-equity, D/E, ratio remains pristine at roughly 0.14, significantly lower than legacy retailers, giving them massive flexibility to fund that $125 billion capex without sweating interest rates. The PEG ratio, price/earnings to growth, is where the bull case gets interesting. Amazon sits around 1.5 to 2.0. A PEG under 1.0 is considered undervalued, so Amazon isn't cheap by traditional standards. However, it is arguably cheaper than Tesla, TSLA, which often trades at a massive PEG premium due to its growth narratives. The price-to-book, PAB, ratio is hovering around 6.6x, which is high for a retailer. Walmart is usually 5x, but standard for a tech monopoly. The story these numbers tell is clear. The market treats Amazon as a high-margin tech company first and a low-margin retailer second. If AWS margins compress due to AI competition from Google or Azure, that PE of 32x will look expensive very quickly. Qualitatively, Amazon operates with arguably the widest economic moat in history, but cracks are forming. The logistics moat, Amazon's fulfillment network, is its fortress. They have regionalized their U.S. network, meaning products travel shorter distances, slashing costs and speeding up delivery. This is a massive competitive advantage over Google, which has no physical logistics, and a step ahead of Walmart, which is still retrofitting stores to act as warehouses. This efficiency is the invisible driver of their recent margin expansion. The cloud moat, AWS, this is where the anxiety lies. While AWS is the market leader, 30% plus share, Microsoft Azure and Google Cloud are growing faster. The qualitative risk is that in an AI-first world, enterprises might prefer Microsoft's ecosystem, integrated with OpenAI and Office 365, over AWS. Amazon is fighting back with its Trainium and Inferentia chips, custom silicon designed to lower the cost of AI. If Amazon can be the cheapest place to run AI models, they win. If they can only be the biggest, they might lose share. Regulatory environment. We cannot ignore the FTC. The antitrust pressure on Amazon remains intense, specifically regarding how they treat third-party sellers. Unlike Costco, which is beloved by regulators and customers alike, Amazon is viewed with suspicion. This regulatory discount is real. It prevents the stock from commanding the same premium as a cleaner story like NVIDIA. Brand and trust. Amazon's brand has shifted from the everything store to a utility. It is essential but not necessarily loved. This contrasts with the high customer loyalty of Apple. Amazon is betting that utility, speed, and price matters more than affection. Amazon is never content with just two businesses, retail and cloud. They are actively building three potential fourth pillars. 1. Amazon Leo, formerly Project Kuiper as mentioned in the news section. This is the 2026 headliner. By launching thousands of low Earth orbit satellites, Amazon plans to become an ISP, Internet Service Provider, for the unserved world. Comparison. This is a direct war with SpaceX's Starlink. Starlink has a massive first-mover advantage, but Amazon has a customer base of 200 million Prime members they can bundle this service with. If Prime Internet becomes a reality, it immediately disrupts the telecom industry. 2. Healthcare. One Medical/Amazon Care. Amazon continues to integrate its One Medical acquisition. The goal is to make Amazon the front door to healthcare. Comparison. Walmart recently scaled back its healthcare clinics, citing lack of profitability. Amazon sticking with it shows a divergence in strategy. Amazon sees healthcare as a data and prime retention play, not just a service. If they can integrate pharmacy pills, PillPack, with doctor visits, One Medical, they unlock $1 trillion TAM, total addressable market, that Google and Apple are only touching via wearables. 3. Zoox, autonomous vehicles. Zoox is Amazon's robotaxi division. Unlike Tesla's vision of turning existing cars into robot access, Zoox built a carriage-style vehicle from scratch. Comparison, Waymo Google, is the clear leader here with operational commercial fleets. Zoox is playing catch-up. However, the hidden value of Zoox isn't just carrying people, it's carrying packages. If Amazon can automate the last mile of delivery using Zoox technology, they eliminate their single biggest expense, the driver. This is a long-term play that justifies the burn rate for now. The bull case for 2026 is the cash flow inflection theory. Bulls argue that the massive capex spending on AI infrastructure today is essentially building the railroads of the next decade. As AWS integrates this capacity, margins will expand violently. Furthermore, the retail business is finally profitable on its own, without AWS subsidies, thanks to regionalization and advertising. Speaking of advertising, Amazon's ad business is now generating over $60 billion a year, more than the entirety of YouTube. Bulls see Amazon as a sum-of-the-parts monster, a cloud monopoly, a logistics monopoly, and an advertising giant, all trading at a reasonable 32x earnings. The bear case is the erosion theory. Bears argue that Amazon is being attacked on all fronts. In retail, Temu and Shine are undercutting them on price, while Walmart matches them on speed. In the cloud, Microsoft is stealing the high-end AI workloads. The result? Amazon is forced to spend $125 billion a year just to maintain its position, not to grow it. This massive spending destroys free cash flow, leaving shareholders with no dividends and a stock that is dead money for years while Nvidia and Microsoft capture the actual value of AI. In conclusion, Amazon in 2026 is a battleground stock. It is no longer the easy buy-and-forget growth story of 2015. It is a mature giant undergoing a massive capital-intensive pivot. If you believe the cloud and advertising segments can outpace the massive spending requirements, the stock is undervalued at $230. If you believe competition is permanently eroding margins, it is a value trap. For the long-term investor, the Prime ecosystem remains the most powerful consumer lock-in in history, which tilts the odds in favor of the bulls. Thank you for watching. Like and subscribe if you enjoy the information.